Today, we're going to explore divergence trading, a powerful method for spotting market reversals and confirming trends. This guide will take you through everything you need to know about regular and hidden divergences. By the end, you'll not only understand how to recognize these patterns, but also how to trade them with confidence and skill. Divergence happens when the price of an asset moves differently from a technical indicator. It's like a disagreement between price and momentum, and this difference can often signal trading opportunities. To trade divergence successfully, you need to understand its two main types. Regular divergence usually means a market reversal might happen, while hidden divergence often suggests the current trend will continue. Once you know how to spot these patterns and when they are most likely to work, you'll have a strong tool for navigating the market. Regular divergence helps identify potential market reversals by showing when price and momentum indicators display opposing behaviors. This divergence appears in two forms. Bullish regular divergence. Price makes lower lows, while the indicator forms higher lows. While the price suggests continued selling, the higher lows on the indicator reveal diminishing selling momentum. This reduced downward momentum often signals potential buying pressure building up, leading to a possible price reversal. Bearish regular divergence. Price creates higher highs while the indicator shows lower highs. Though the price reaches new peaks, suggesting strong buying, the decreasing peaks on the indicator show declining buying momentum. This weakening momentum often signals that the upward movement may reverse. While price moves in one direction, the indicator suggests weakening momentum in that direction, often preceding a market reversal. Hidden divergence is different from regular divergence because it doesn't focus on reversals. Instead, it helps confirm that the current trend is likely to continue. For example, in an uptrend, if the price forms higher lows, but the indicator creates lower lows, it suggests that the uptrend is still strong and is likely to keep going after a pullback. In a downtrend, hidden divergence appears when the price makes lower highs, but the indicator shows higher highs, signaling the trend will probably resume after a pause. Divergence analysis is versatile and can be applied to any technical indicator that measures momentum, volume, or trend strength. While you can use almost any oscillator, certain indicators have become popular choices among traders due to their specific advantages. The Relative Strength Index, RSI, excels at identifying potential market reversals through overbought and oversold conditions. Its clear numerical boundaries, 0 to 100 scale, make it particularly effective for spotting divergence patterns, especially when price reaches extreme levels. The Moving Average Convergence Divergence, MACD, proves especially valuable in trending markets. Its histogram component provides visual confirmation of momentum shifts, making divergence patterns easier to spot. The histogram's size and direction help traders gauge both the strength and potential duration of these divergences. The stochastic oscillator shines in ranging or sideways markets. When combined with key support and resistance levels, it helps traders identify potential reversals with greater accuracy. Its sensitivity to short-term price movements makes it particularly useful for shorter timeframe trading. For traders seeking a comprehensive approach, the Divergence for Many Indicators V4 indicator by Lonesome the Blue combines these tools and more. Shout out to Brian LeBlanc 2758 for bringing that up. This script allows traders to monitor multiple types of divergence across different indicators simultaneously, streamlining the analysis process. The script allows to detect both regular and hidden divergences, offering flexibility to suit different trading strategies. It includes customizable features such as pivot point settings, divergence types, and visual options like line styles and colors, ensuring the tool adapts to individual preferences. By consolidating multiple divergence checks into a single interface, it eliminates the need for multiple indicators. To trade divergence successfully, you need to adjust your approach depending on the type of divergence. Regular divergence is about reversals, so trades based on it often take more time to play out. Because of this, you might need to use wider stop-loss levels to give the trade enough room to develop. It's also a good idea to take profits gradually as the reversal unfolds. Hidden divergence is different because it works with the current trend. This means trades based on hidden divergence usually play out faster and allow for tighter stop-loss levels. These trades are great for joining the trend at a better price after a pullback. Understanding the bigger picture of the market is key to using divergence effectively. Regular divergence works best in extreme conditions, like when the market is overbought or oversold. It's even better when these signals happen near strong support or resistance levels. If you also look at higher timeframes to confirm these signals, your chances of success improve. Hidden divergence, on the other hand, works well in markets with a clear trend. For example, in an uptrend, you want to see the price forming higher highs and higher lows. In a downtrend, you want to see lower lows and lower highs. Hidden divergence is most effective during pullbacks when the trend temporarily pauses, especially near moving averages that act as dynamic support or resistance. The real strength of divergence trading comes when you use both types together. Regular divergence can help you spot when the market is reversing, while hidden divergence lets you trade pullbacks within the new trend. By combining these approaches, you can capture both the reversal and the trend continuation, giving you more opportunities to profit. Trading divergence isn't just about finding patterns. Managing your risk is just as important. You should never trade divergence by itself. Instead, combine it with other forms of analysis, like support and resistance levels, market structure, and candlestick patterns. Make sure you're using the right position size, especially with regular divergence trades, where stop-loss levels might need to be wider because of volatility. Divergence trading is a unique way to understand market behavior, but it's important to stay consistent. Regular divergence helps you find reversals, and hidden divergence keeps you in tune with ongoing trends. Don't act on every signal you see. Instead, focus on high-quality setups that fit with your overall market analysis. The best way to improve at divergence trading is to practice. Start by looking at charts and marking areas where you spot regular and hidden divergence. Higher time frames are a good place to start because the signals are easier to see. Use a demo account to test your ideas and learn how these patterns behave in different market conditions. Over time, you'll develop a feel for which setups work best and how to trade them. Which oscillator do you prefer for divergence trading? Not sure which one to choose? Check out our latest video on 5 different oscillator types.